I want to now turn to our third guest and our last guest of the program. That's James Bullard. And James Bullard is the president and CEO of the Federal Reserve Bank of St. Louis. President Bullard, thanks so much for joining us today.
Great, happy to be here. Let's see if I get my video going here.
I do see you, so I think you're doing well. I think you're doing fine. No, I have a question for you, given your position. I appreciate that you put on your necktie while being at home.
We're very formal here.
What is your life like right now? I mean, you're kind of in the middle of it, but there you are, a guy who lives in a home. Just, you know, I don't want to go on and on about this. I'm just very curious for a little personal check-in with how it's going for you.
We are working remotely. The bank here in St. Louis has about 14 to 1,500 employees. The lion's share of those are working at home. We do have critical businesses, including cash, that require physical presence to work and security. Those employees are at work, and we're taking measures to protect their health as best we can. But we can do a lot remotely. We've got used to mobile technology. I travel a fair amount and work from the road anyway. So in many ways, we're able to adapt.
Are you able to sleep at night?
Well, it's a struggle, I would say, for all of us.
So let's get down to the business of your business. You know, the Fed has taken extraordinary measures in a very short period of time. We have benchmark interest rates down to zero. Quantitative easing has launched again. And the question that keeps coming back is, do you guys have any bullets left? I mean, it was always the case that the Fed could do this, that, pull this or that lever. And now there's an impression that you're very short of levers. What about that?
Well, usually when we think about monetary policy, we think about interest rates, and we did lower the policy rate down close to zero. I don't think this is really a story about the level of interest rates right now. We have a national emergency going on to respond to the pandemic. And I would say our approach has been two-pronged. And I would also say that there's plenty of ammunition from the central bank and plenty of resources. So the first part is to make sure financial markets are functioning. And we did have liquidity problems in some of the financial markets, but we opened up many programs that we used in 2007 to 2009 and some new ones to try to make sure that those markets don't freeze up. But what you want in this situation is price discovery. You want people to be able to trade. Obviously, all kinds of assets around the world are being revalued in response to the crisis. You want that market functioning to continue, and I think we've been successful on that dimension. And then we have the fiscal package, which is not what we did, but what Congress did. But parts of that involve the Fed. And I would say there are really three main elements here that I'd like to point to. And let me just outline how I like to think about this. I know it's chaos out there and people are really adjusting, but think of it like this. You're driving your car down the freeway at 70 miles an hour, and that's like normal GDP and normal economy. We're producing all these goods and services, but then you come to the construction zone. And in the construction zone, you have to wind your way around and drive on gravel and go a lot slower and slow down a lot. And then once you get through the construction zone, you can speed up again. So that's what the pandemic is like from the economy's point of view. You have, instead of being able to produce lots of goods and services and therefore lots of household income, you can only produce a little bit, only essential services and only what can be produced from the home. So GDP, which is our measure of national income, is going to be way, way down during this period. And you're seeing that in the economic numbers. But the good news is that we know where that's coming from. It's not a surprise. We have to adjust to the fact that we have to invest in national health. And so income is going to be very low during this period. Now, Congress has come in and said, okay, we're going to borrow and we're going to distribute that back out to households to try to keep everybody whole. And I think there are plenty of resources in this bill to do exactly that. Some of that comes through the unemployment insurance program, which has been topped off and is stronger than it would have otherwise been. And then some of that is coming through loans to businesses to keep them afloat as we're investing in national health here, and other programs that were in the bill. So I think we have the right amount of resources to handle this situation. And I think that the fact that it's coming from a known source, the disease progression around the world, it's coming from a known source is very helpful in this situation compared to other crises that we faced in the past where it's been much less certain exactly what the cause was.
So your metaphor of the car in a construction zone suggests that the car is basically okay, and when it's past the construction zone, you can put your foot on the gas again. But I want to play with the metaphor a little bit as well, because going through a rough construction zone, you can blow out your tires, or you could get stuck into such a backup on a hot day that your car overheats. And so I'm challenging whether the assumption that the car is going to come out okay holds up. The St. Louis Fed estimated a potential 32% unemployment rate. That's 52 million people for the second quarter. And today, the Small Business Administration has surveyed its members, and the small business employs half of the private sector workers in the United States. The Small Business Administration, the Chamber of Commerce is what I mean to say. The Chamber of Commerce has surveyed its members, and the Chamber of Commerce is saying that 10% of their members say they're never going to open up again, that they're done, they're closed, they can't put it back together again. So that's 5% of that workforce. That's still a lot of people and a lot of flat tires. And so what I'm questioning is where your optimism comes from that the fourth quarter is where things start to zoom again, especially given the whole specter of a second round of the virus itself getting a second wind as the weather turns cooler again in September, October. So where does your optimism come from on this?
Yeah, I would say on the rebound question, a lot of people are talking about reinfection. I just think that there's so much emphasis on that already that we're probably not going to be at that much risk. I think technology will help us a little bit here. We'll get better testing. We'll get better understanding of the virus itself. We'll get better understanding of at-risk members of the society and so on. So much needs to be done. I totally agree with that, and much could go wrong, but it's possible to get it right. And one thing that I think is very encouraging here is that you had Congress act very, very rapidly. If I'm not mistaken, it was a unanimous vote in the United States Senate. When do you see that? And then the Fed acted very, very rapidly as well. And so you have this very strong response, very quick response. But I think you should think about the second quarter as being the disrupted quarter. Instead of producing the $5 trillion worth of goods and services that we would normally produce in the second quarter, the health authorities are asking us to basically shut almost everything down except essential services and what can be done from the home.
But if you have bankruptcies as a result of that cutback, I'm sorry to interrupt, but we're a little bit out of sync, so it sounds like we're talking over each other when we don't mean to be. But I just want to ask if, there's strong indication, strong likelihood that some significant players may be facing bankruptcy. Oil industry is very much at risk. And if there are other bankruptcies, how do you restart in that third quarter, in that fourth quarter, when players may just be taken out of the game?
Yeah, I mean, here's the concept, at least in my mind, and I'd like to get the views of the audience here too. But there are enough resources here, so we would normally produce $5 trillion worth of goods and services. Health authorities are asking us to shut that down. Let's say 50%, just for round numbers. So that means $2.5 trillion worth of income that's not going to be earned during the second quarter. Now, the Congress's bill has plenty in it. One way to replace that income is use the established unemployment insurance program, call it pandemic relief, which I think is more appropriate in this situation. Keep those households whole during the period while you're waiting out for the virus. And then for businesses, we've got the Small Business Administration component, about 350 billion, quite a bit of firepower there. And you've got other programs that the Congress has also authorized, some of them jointly with the Fed. So I think there are enough resources. The real challenge here is how can you get that money to flow to the people that have been most disrupted, and make sure you keep them whole during the period while you're waiting out the virus, and make sure that when the time comes and we get the all clear signal, that we open up the economy in a responsible and safe way. And
well, let me jump in, because very much on the point you're making, we have a question from Connor Scahill, a question for James. What need to be communities' top strategic priorities to prepare for post-pandemic economic development?
Yeah, I think near term, one of the biggest issues is to make sure that all these different entities that are being disrupted by the health orders are able to go get the resources that have been made available. And like I said, lots of resources have been made available. One of the simplest is to go get the unemployment insurance that is being provided. That's been made more generous. I think the Congress was trying to keep people paid at 100% if they can, or close to it. Then they're able to pay their bills. They're able to maintain their life situation while they're waiting for the virus to naturally deteriorate here and naturally go away, and we're able to open up the economy again. So, like I say, I think, and those nonprofits, I think, are critically important too. They can also get help through this process. So I think there's a lot that can be done.
The St. Louis Fed in 2007 published a paper that looked back at the economic impacts of the Spanish flu epidemic of 1918 and 1919. And it found that the economic impact was severe, but quite short-lived. The recovery was very quick. But the very same paper back in 2007 felt that the federal government was not prepared for a pandemic on the scale that we're having now. So my question is, what do we learn from 1918, for better or worse, that's applicable now, and actionable lessons from 1918?
Yeah, I mean, the 1918 pandemic was a complete disaster, killed five times more people than World War I. So I think the nature of healthcare was very different at that time. The nature of understanding of what was happening was very different, spread all around the world. I don't think we're in that situation today with all the technology we have in the healthcare environment. I mean, it's a chaotic situation, and it's a national crisis, and you should expect it to be chaotic. But as far as the government response, and really the global response, it's far more responsible, far more informed than it would have been in 1918. So I think we can expect a better outcome than they got at that time.
And to that point, a question for President Bullard: should we be afraid that the banks will fail? Should we take all of our cash out of our accounts? I know you're going to say no, but I want to hear why. And is there any advice for us regular folks who don't have a lot of money?
Yeah, this is not, and Maya McGinnis spoke to this earlier, this is not really a financial crisis. A lot of comparisons are being made to the 2007 to 2009 period, but that was a very different situation where some of these Wall Street firms blew up in the middle of the biggest financial market in the world, and that reverberated around the world. That's not what's happening here. We have had some market functioning, but again, issues, but the Fed stepped right in right away to try to get those to settle down. I think that the banks can play a very constructive role here in helping to channel the funding that's been provided by the Congress to disrupted businesses and disrupted industries. Again, I think it's very possible to keep everybody whole during the second quarter here, which is the quarter that will be the period of most disruption. And if that works, we'll end up with more debt. But on the other hand, everyone will have made it through. We'll create a bridge to the other side of this crisis. and we'll be able to restart the economy in a responsible and healthy way when we get to that point.
Yeah, it's interesting. I've heard you say in other interviews that you don't consider the $2 trillion to be a stimulus package, but more like a lifeline package. There's no
Yeah.
expectation that people are going to go stimulate the economy with their $1,200 checks. It's more like they're going to pay their rent.
Yeah, absolutely. And I think, conceptually, that just shows how hard it's been for us macroeconomists to get our heads around what's going on here. But you're not trying to produce a lot of goods and services during this period where you're trying to combat the virus. You don't want people to get back on planes. You don't want people to go to bars, and you don't want people to go to basketball games. You don't want any of that.
It's the opposite of stimulus, really.
People to hunker down, stay at home, lie low, but still be able to pay their bills. That's the concept of what you want. But of course, the numbers that you get on the economy are going to look horrible, but they're not really horrible, because what you're doing is getting relief to the right places, to the people that have been disrupted. That's why I'd like to make extensive use of the unemployment insurance program during this period and call it, let's call it pandemic relief, which is really what it is. We're not trying to stimulate the normal levels of consumption that we would normally see in the economy. We're just trying to lay low and get past the virus and then open up on the other side without doing a lot of damage to the economy in the meantime.
We just passed through the 1st of April, which, in addition to being April Fool's Day, didn't come with a lot of glee or humor this year, was also when people are due to pay their rent. And in New York City, we have a statistic that some approximate 40% of tenants won't be paying their rent in New York City. What's the impact on the broad economy of people not being able to pay their rent and not being able to pay their utility bills? How do they avoid eviction? How do they avoid having the lights turned off?
Well, that's exactly the concept of trying to keep people whole during this period. In principle, if people are able to go and get their unemployment insurance check or their pandemic relief check, then they should be able to pay their bills, and then we would avoid specters of not being able to pay the rent and getting evictions and all kinds of stuff. We're supposed to have enough resources, if we can get those resources to the right people, that they're able to make those payments and maintain the situation until we get to the other side of the pandemic here.
But very literally, $1,200 might go quite a way in a rural part of Oklahoma, but in Manhattan, it's not going to do you any good at all. And putting that on top of utilities and everything else. So I come back to this question about people not being able to pay their rent or pay their utility bills. What is that just going to happen? We'll see evictions happening.
I'm sure there'll be. I'm not pretending that this is going to work perfectly. That would be a story about not being able to get the resources to people that have been disrupted fast enough so that they can make their payment. But there are many channels that are going on here. You have this $1,200 part of the bill that's going out to basically the lower part of the income distribution, so that should be helpful. But in addition, you can apply for unemployment insurance and get relief through that channel. And then in addition, your employer can apply for the loan, which is forgivable. That's the SBA lending. So all these things add up to quite a bit of cash and should be able to make up for the lost income that we've otherwise had. It's also a tough era. There's no question about that. So part of how we're paying for this is just less consumption than we would otherwise have. And most of that's because you just can't consume at the same rate that you probably would have, because a lot of the things we would normally do are all shut down during this period, and we're just hanging out at home. So what I think about this situation is that conceptually, it's not difficult. Conceptually, we want people to go home and sit on the couch, work if they can do so safely, but basically we're shutting down intentionally a big portion of the economy. That's not hard to understand. we know what that is, and we kind of know what that will cost, and we kind of have the right amount of resources that have been passed by the Congress to take care of that. What's really difficult is the execution aspect of that. How can we make sure that that money gets to the right people at now, which is really when we right now?
That is the issue. My two takeaways, paraphrasing two things you said, is we should expect chaos, and it is possible to do this right. So I'm going to hold on to those two thoughts, James Bullard. I want to thank you very much for joining us today. Thanks so much for talking to us.
Thanks so much for having me. I really appreciate the opportunity.
Thank you. And that wraps up this week's Atlantic Event Cast. I want to thank our audience for tuning in on this busy Friday. For the latest information, I want to tell you again on the pandemic, visit theatlantic.com. There are going to be more events like this one upcoming, so please keep an eye out for those. I'm John Donvan. Thank you so much for joining us.